Hello friends, good day to you all. I welcome you all for today's episode on basics of insurance, that is principles of insurance. In our previous episode, what we have seen is regarding basics of risk management, wherein we have defined what is risk and various steps in risk management, how the risk is controlled, and how the insurance has come into existence through the process of risk transfer step in risk management, and all those things we have seen. And today we will see the basic principles of insurance. When we talk about basic principles of insurance, it's very important to understand the insurance domain is a very typical and very specialized field. And over a period of time, it has developed certain basic principles based on which the entire subject domain is standing. These principles are very important from disputes adjudication process, because any violation of this principle will put the violating party to disadvantage, because these principles cannot be violated. And now coming to the actual principles, we will discuss 6 principles. Number 1, insurable interest. Number 2, proximate cause. Number 3, utmost good faith. Number 4, principle of indemnity. Number 5, principle of subrogation. And number 6, principle of contribution. These 6 principles form the very basis of the subject of insurance. We will see these principles one by one with suitable examples for a proper understanding of the principles. The first principle we are going to discuss is the principle of insurable interest. Now, insurable interest is defined as an asset or potential liability as subject matter of insurance with which the insured has legal relationship that will lead to financial loss to the insured when exposed to a peril. Now, it's very easy to understand. Basically, we need to have an asset as subject matter of insurance, or it could be a potential liability, like we have third party liability when we drive a car or two-wheeler, right? And the insured should have legal relationship with this asset. When he has a legal relationship with this asset, and when the asset is exposed to a peril, the insured will suffer a loss. Then we say the insured has insurable interest in the subject matter of the insurance. Like for example, an individual has insurable interest in his own life. He has insurable interest in his children. He has insurable interest in his spouse. An employer has insurable interest in his employees. A creditor has insurable interest in the person to whom he has given the credit, right? Say for example, I have a house. I bought a house taking loan from the bank. Now bank will have insurable interest in the property. The bank will have insurable interest in my life, because they have legal relationship to the extent of the loan when they gave loan to me for buying this house. So they have insurable interest to the extent of loan only, right? So basically, insurable interest is very important in the sense the insured should have insurable interest at the beginning of the policy, when the policy, at the time of policy inception, and during the course of the policy period, and at the time of making the claim. Then only the claim will be admissible and the liability of the insurance company will be established. Say for example, I have a house and I have taken earthquake fire policy with earthquake extension covering the risk. Now during the course of the policy period, I sell my house to some other person, right? After I transfer the property on somebody's name, there will be an earthquake and extensive damage will happen to the house. Now, just because I have taken the policy, I cannot go to the insurance company and make a claim, because I cease to have insurable interest at the time of making the claim. I don't have insurable interest. Okay. Similarly, when you take a car with car loan and the car is stolen, the company, the bank or company whichever has given loan for purchasing the car will have insurable interest in the car, and the insurance company will pay directly to the company, bank that has given loan based on the bank clause and the endorsement. So insurable interest is the fundamental principle guiding the insurance. We cannot take, say for example, I cannot take insurance policy on you and you cannot take insurance policy on me, because insurable interest does not exist. Now what happens? The legal problem here is, at the time of inception of the policy, if the insured misguides the insurance company regarding the insurable interest, fraudulently obtains the insurance policy, and at the time of making the claim, if the insurance company finds out the person did not have insurable interest at the time of inception of the policy, then the insurance company will deny any claim, settlement of any claim. So it's very important to understand that one should have insurable interest at the time of inception of the policy and through the policy period and at the time of making the claim. And it's also important to note that there is one exception for this. The exception is in marine insurance. In marine insurance, it is sufficient if the insured has insurable interest at the time of making claim. He need not establish that he had insurable interest at the time of inception of the policy and through the policy period. Just at the time of making the claim, if he has insurable interest, that is good enough, and the insurance company will honor the claim. The second important principle of insurance is proximate cause. This is typical to general insurance, right? And proximate cause is defined as the active and efficient cause that sets in motion a chain of events which brings about a result without the intervention of any force started and working actively from a new and independent source. This is a little confusing. One thing we have to note is this proximate cause is not defined in the Insurance Act. Over a period of time, based on case law, this concept has developed. This is very important to insurance domain because, see, basically the insurance depends on causality. That is, there is a cause of loss. That is the basis. When we speak of cause of loss, now there are two types of insurance policies: named risk policy, all risk policy. In named risk policy, what is happening? The insurance company or the insurer lists out all the causes, all the perils for which he is obliged to settle the claim. He is agreeing to settle a claim. Literally, he lists the causes, the perils, and anything that does not appear in this list, he is not liable to pay the claim. So the cause of loss is very important for establishing the liability of the insurance company for making the payment. In the other policy, all risk policy, in the named policy, they list out the risks. In all risk policy, what they list out is all risks are covered except the risks that are listed as not covered. Other than what is listed as not covered, every other risk means based on fortuitous events, not man-made and voluntary events. Only fortuitous events. All risks are covered except those risks that are specifically mentioned as not covered. Now based on this, the cause of loss becomes absolutely important. Okay. Now, when we say cause of loss is important, then there can always be a possibility of dispute between the insured and the insurer. Before actually discussing what is proximate cause, let us just review an example of a tsunami loss. Till tsunami happened in India, no one was aware what it is like to have tsunami. As a matter of fact, none of the Indian languages have the equivalent word for tsunami, because we never experienced it. We didn't need the word tsunami, whereas for Japanese it's a daily problem, so they have the word tsunami. And we have adopted the same word. Now, when tsunami loss occurred, many people had loss to their property. They suffered loss. They made claims. Now, some people got the claim settled. Some people's claims were denied by the insurance company. The reason is that people are familiar with flood loss in India, and almost all people have flood loss coverage for their property. But earthquake is not seen in all places in India. Only in some places it is possible, depending on the seismic zone classification. And people do not take this earthquake extension. It is not part of the regular coverage. People will have to pay additional premium and take earthquake extension. Now, many people have not taken earthquake extension because they didn't expect that they are vulnerable to earthquake. They are only vulnerable to flood, so they have taken flood loss. Now, when the claims are made following tsunami, insurance company said, because you have not covered for earthquake, and earthquake being the proximate cause for the loss, the claim is not admissible. Now, looking from the insured point of view, it is only water that has caused the damage. But as a matter of fact, it is the earthquake that set off a chain of events which are not disturbed by any independent source that led to the damage. The sea levels raised because of earthquake. So, earthquake is the proximate cause for the loss. So, this is how proximate cause is. It is an effective and efficient cause that lead to the loss, right? Without any interference from any external source. Let's see, because this proximate cause can be understood only through examples, and at the end of the day, again, court may say what is proximate cause and what is not proximate cause. When both the insurance company and the insured, they go for adjudication, it's ultimately court's word that prevails. What is proximate cause and what is not proximate cause. So let's take another example of an accident. A person meets with an accident. He has taken accident policy, right? So if he dies in an accident, he will get compensation. It's perfectly all right. But what happens following the accident? The person did not die, but severely injured, taken to the hospital. He had undergone surgery, hospitalized, and during hospitalization he contracted corona, and soon he died because of the complication rising out of corona. Now, insurance company says he died because of corona, therefore he is not eligible for accident insurance claim. But if it goes to court, court may say that accident is a proximate cause. Corona is not the proximate cause. A person who suffered accident and hospitalized because of accident and who had undergone because of accident injuries may die for several reasons in the hospital. But he may die because of surgical complications. You cannot say that he died because of surgery. He may die because of contracting some secondary infection in the hospital, which is not in his control, and he may die because of the complications arising out of this infection due to his surgery. So, accident becomes the proximate cause. Therefore, insurance company is liable to pay the compensation as accidental death, though corona has interfered at one stage. Right? So, this proximate cause is a matter of adjudication, and we have to understand that proximate cause cannot be fixed in any concrete terms. We have to understand whether the cause is efficient or not. Say, for example, there are two multi-story towers, multi-storied apartment buildings close by in the same complex, right? One tower is insured for earthquake, the other tower is not insured for earthquake. Okay? Let's say tower A is insured for earthquake, tower B is not insured for earthquake. Now tower A, there is an earthquake and tower A suffers extensive loss, and then it leans, and actually it leans completely onto the tower B. Tower B is not yet disturbed. Tower A totally leaning onto the tower B. Okay? During the course of demolition of tower A, because it cannot be left like that fully leaning, so it has been completely demolished. During the demolition, by falling of this tower A onto B, tower B also gets damaged. Now tower A has got earthquake insurance, their claim gets settled. Tower B does not have earthquake insurance, but they make a claim. Because the damage is not because of earthquake, the damage is because of the falling of this building onto it. So they make a claim based on the falling of object damage. Now the insurance company says earthquake is the proximate cause, not the falling of object. Because the tower B doesn't have earthquake insurance, they deny any claim. Now that's how this proximate cause works, right? So ultimately we have to understand it as what is the most efficient and direct cause, okay, that lead to the loss of the asset. This is very important because it has got legal implications. Okay, and many disputes arise because, see, at the end of the day, ultimately what is insurance? The cause of loss is accepted by the insurance company, then they make the payment. If they don't accept the cause of loss, then they don't make. How to make them accept if it is really the proximate cause? It's only through adjudication. The next important principle of insurance is called utmost good faith. This is also known as uberrima fides. For understanding the principle of utmost good faith, we have to go to the principle what is called caveat emptor, buyer beware. When we understand this principle caveat emptor, buyer beware, then we will understand utmost good faith automatically. Now what is buyer beware? Let's say you go to a shop for buying a washing machine, and the salesman selling the washing machine will make you a presentation. He will talk to you everything that is required for you to take a decision to buy the washing machine. He will tell all the advantages, everything that is required for you to take a decision. But he will not tell anything that is disadvantageous to him. Right? He will not tell you how many complaints this particular model they have received in the past 1 year. If you ask, he will tell, but he will not tell you voluntarily. He is not obliged to tell you, and he is not doing any illegal act by withholding that information. If you ask, he will tell you. Otherwise, he will not tell, because it is a disadvantage to him, and he is not lying. When you ask him, are there any complaints? If he says there are no complaints, then he is lying. Now the onus of finding out this information and many such other points is on you as the buyer. That is why it is said, buyer is beware. You have to make suitable inquiries with your friends, relatives who purchased the same model and who have been using it for some time, and then they will tell you their experience and if there are any complaints, and you don't expect this information from the salesman who is trying to sell you this. So this basically buyer beware. That is, as a buyer you have to be careful in getting whatever information you require for the purpose of taking the decision to buy the washing machine. And from this, when we move from buyer beware and when we move to utmost good faith, the principle of utmost good faith says both the parties, insured as well as the insurer, they have to disclose all the material information pertaining to the insurance contract. And the insured is obliged to reveal all the information, material, to the subject matter of insurance that will facilitate the insurance company, that is the underwriter, to take a decision whether to accept the risk or not. And if he has to accept the risk, under what terms and conditions he can accept the risk. It's very important. The reason is that the information, let's take the case of health insurance. The health background and the past health record of the insured is only known to the insured. The insurance company does not know unless the insured informs the insurance company about the past record, about the diseases he has suffered earlier and about the surgeries he had undergone. The insurance company will not know, but this information is material to the subject of insurance, and it's very important for the underwriter to take underwriting decision, whether to accept the risk or not. A specific case of this information is, let's take pre-existing disease. A person is having some pre-existing disease. If he discloses this information under principle of utmost good faith to the insurance company, insurer, then insurer will take a decision to accept this utmost good faith for a period and give a waiting period for covering whatever this pre-existing disease and the consequences of pre-existing disease. If the insured does not disclose this information and the insurance company issues the policy not knowing the pre-existing disease, and when a claim is made and if the insurance company discovers regarding the existence of pre-existing disease, then the insurance company can deny the payment, and it will deny the payment. So it is very important on the part of the insured to disclose all the information. Similarly, the principle of utmost good faith applies to the insurance company also. The insurance company also have to inform all the information that is required pertaining to the subject matter of the insurance. For example, they have to inform what are the exclusions that they are not going to pay for the health insurance policy. They have to list out, and there should not be any surprise for the insured at the time of making claim. Right? So this principle of utmost good faith is applicable to both the insured and the insurer. So they have to disclose all the information relevant and pertaining to the subject matter of insurance, that is a material, whether asked or not. The next principle what we are going to see is the principle of indemnity. To say in simple terms, the principle of indemnity is, following a loss, the insurance company will put the insured exactly in the same position as he was just moment before the loss has happened. Nothing more, nothing less. This is the principle of indemnity. This is basically applicable to general insurance. In life insurance, the sum assured is fixed, so the indemnity question does not come there. On death benefit or survival benefit, whatever is fixed at the time of inception of the policy will be paid by the insurance company. So this principle of indemnity is more relevant and unique to the general insurance. Let's say in a fire policy, the factory building suffers loss. The sum assured is 10 crores and the loss happens to be, say, the claim may be, say, 5 crores. but the loss assessed by the insurance company is 3 crores. Then under the principle of indemnity, the insurance company will pay only 3 crores to the insured. Not what is claimed, not what is assured as a sum assured under the policy document. So this is basically the principle of indemnity. So a corollary of this principle is that the insured cannot make profit through the process of insurance. This is not permitted, it becomes illegal based on the principle of indemnity. Next important principle of insurance is called the principle of subrogation. We can understand this by considering a simple example. Let's say you have a house. You have covered the house and including the compound wall for risk. Okay. Now your neighbor, while taking his car out, he dashed against your compound wall and the compound wall collapses. There is a damage. Now you can always make a claim against the insurance company and then get the claim settled for the damage to the compound wall. To that extent is fine. Now after receiving the claim money from the insurance company, you cannot go to your neighbor and tell him that you are responsible for the damage, you have to pay me compensation, and ask him to invoke his third party liability, because his car has got a policy that covers third party liability, and you cannot go and ask the your neighbor to make a claim on third party liability on his insurance company and make the payment to you. This is illegal because you have already got your claim settled by the insurance company based on your policy. Okay. Now this particular, it does not mean that your neighbor is not responsible. While you are not allowed to make the claim on him, it is not that he is not responsible. He is responsible, and then his policy has to pay third party damage. But the right of this collection passes on to the insurance company following your claim with the insurance company. This is called the principle of subrogation. The recovery rights from the responsible third party for the claim made by you lies with the insurance company, and then you have to do everything that is required to transfer this right to the insurance company. This is the principle of subrogation. Whatever evidence you have to provide to the insurance company to facilitate recovery from the third party who is responsible for the accident, you have to do, and then it is obligatory on your part to assist the insurance company to exercise their right under this principle of subrogation to recover from the responsible third party. So this is the principle of subrogation. The next principle of insurance is called the principle of contribution. This looks simple, but this will lead to a real frustration at the time of settling claim. This we will see how. The principle of contribution is simply that when you have asset covered by two different policies, the policies will pay claim based on the proportion of the premium they have received. Based on that, you cannot claim for the same loss from two different insurance companies. That is illegal. Right? So both the insurance companies will pay in proportion to the premium they have received to cover the loss to the extent of indemnity. That is, they will not indemnify separately two times. This is the principle of contribution in its simple terms. Now what is the problem? It has got a very serious problem when it comes to, say, fire insurance, let's say. Now what happens? We have seen during the course of our discussion on risk management, there is a step called risk retention. Part of the risk we have received without doing any insurance, right? Now let's say we have a factory and it is insured not fully. So the total asset value is 10 crores. We have not insured for 10 crores. We have insured only for 5 crores, assuming that 5 crores insurance is enough. Insurance company may not object when you ask for. If they want, they will tell you that you have to cover fully 10 crores. If you cover less than 10 crores, they will inform you that it will go as under insurance. That's all they will inform, because their duty is over under utmost good faith by informing you that you are running under insurance by covering only 5 crores for an asset of 10 crores. Now what happens? This factory suffers fire loss, the entire 10 crores gets wiped out, whole factory gets wiped out. Now you make a claim. Now what happens? The claim, you make a claim of 10 crores. Okay? Rather, you cannot make a claim of 10 crores because you have only covered for 5 crores. You know that. So, though you suffered a loss of 10 crores, you will make a claim for 5 crores because that you have suffered total loss. Now, the insurance company will assess the loss based on depreciation and all those things. They will assess the loss to be, say, 3 crores. The surveyor makes the assessment and then it is given to the insurance company by the surveyor as the loss is 3 crores. Right? Now what happens? Because you have insured only for 50% of the value, the other 50% is retained by you and it is considered as self-insurance. You are your own insurer. Now the loss is to be covered by two insurers, that is yourself one as a self-insurer and the other by the insurance company on who you have taken the policy for 5 crores. Now the principle of contribution kicks in. The last 3 crores will be indemnified by both the insurers in the same proportion as the premium, that is 50-50%. Right? Now the insurance company will pay only 1.5 crores as the claim. For a loss of 10 crores and for a claim of 5 crores, the settlement will be only 1.5 crores. The other 1.5 crores of the assessed loss you are supposed to bear as self-insurance. This is where the problem of contribution plays out through underinsurance. Many a time what happens, factory they do not cover their assets, small and medium factories, and the bank when they extend loan for buying machinery, bank will insist on insurance for their machinery, while insurance companies do not agree for giving only for part of the assets. They say all or none, but generally public sector insurance companies for bank funding they permit this part insurance. But then what happens? When the claim comes under the bank clause, whatever money is paid by the insurance company will go directly to the bank, and the insured will not get anything. So this principle of contribution works indirectly. While there are very few cases where people insure with two insurance companies for the same asset, this underinsurance is a major problem that is played out by the principle of contribution. Friends, in today's episode, what we have discussed is about basic principles of insurance. I hope you enjoyed this session. In our next episode, we will be discussing the working of the insurance company, different types of intermediaries, history about our insurance business in India, and some regulation. Thank you.